Back with Bobby and JJ Radio. Want to say happy Sunday. Today we're talking about all types of investments, and we have a very special guest, Mr. Greg Drew. He is an accredited financial advisor. He is from San Antonio. He's married with 3 kids, and he is the author of an incredible book called Doing It Right, Achieving Financial Freedom. I want to say thanks, Drew.
Can I get a signed copy?
Yeah, Bobby wants a signed copy. Yeah, he wants your autograph. He's been asking for your autograph for a little bit here. But I want to say thank you for hanging out with us today.
Oh, this is great, sure.
Yeah, and I know that it's hard to get some people when you're filled in, but we're glad that you're here to educate the community on a bunch of stuff. So let's talk, jump right in. What is an accredited investment fiduciary?
An accredited investment fiduciary is a special designation that one gets after they've had a course of study. And really what it does is it separates, I'll say, run-of-the-mill financial advisors from somebody who is an accredited investment fiduciary. And the difference is this. If you're a run-of-the-mill financial advisor, you are held to a lower standard of fiduciary care. And it says that the investments that you recommend must be suitable for the client.
Okay.
But just suitable. It's interesting that they don't have to be in the best interest of the client.
Right.
When you're an accredited investment fiduciary, you have to meet a higher standard of fiduciary care, meaning not only does the investment have to be suitable, but it also has to be in the best interest of the client. So there's a
suitable and
there.
best interest is huge.
It's huge.
When you're talking about investments.
Yeah, absolutely.
What is the percentage of people or financial advisors that are financial investment fiduciary accredited?
Bobby, I'd love to answer that question. I really don't know the percentage. It's probably very small.
Mm-hmm. It's probably like in the
single digits. I'm sure.
I'm sure it's like in the commercial real estate world. CCIMs are very rare. There's only 8,000 in the whole world. And there's countless numbers of real estate agents. It's probably the same kind of thing. Yeah. So let's talk about what is the difference between fee-based and commission-based pay in your industry?
Yeah, financial advisors can run their business a couple of different ways. One way is commission and one way is fee-based. I prefer to be a fee-based financial advisor, and here's why.
Sure.
If I was basing my business on commissions, I would be attracted to products, investment products that maybe pay a higher commission that, again, might not be in the best interest of the client.
Right.
When you are fee-based, my fee is based on the size of the account, and it puts me and the client squarely on the same side of the table.
Right.
Every client I have wants 2 things. They want their investments to grow and be protected.
For sure.
Fee-based financial advisors want the exact same thing.
So you're on the same side.
Absolutely.
And go ahead.
It's okay. So what's the minimum account that you're working with? I don't want to name names, but there's some people that say, hey, I only work with $250,000 plus, or you have to have this much in assets. How's your viewpoint on that?
JJ, I'm asked that question all the time, and my response is always the same thing. I don't have a minimum. And the reason I don't have a minimum is, I guess there's a couple of reasons. I don't necessarily need a sale necessarily now in my position in life.
Sure.
And I don't know who my smaller clients actually know. So if somebody comes to me, they're young, they don't have a lot of money, they really just need some help getting started investing and saving and a little lessons about how to spend your money correctly, I'm happy to do that. I understand that, I'll probably lose money on that account, but it doesn't really matter to me because I'm going to help them out. It makes me feel good. And again, I don't know that they might have a rich uncle who lives over the Eagle Ford Shale. I just don't know.
You never know. Absolutely.
Right. So, Greg, tell us about your business and what you do.
Well, as a financial advisor, we work with individuals, helping them invest their money in the most appropriate and proper way. Mm-hmm. We also work with companies establishing their 401k and retirement plans. The process that I go through with really every client is, first of all, we will help them define what their risk tolerance is. Mm-hmm. We'll help them define what their investment objective is. Mm-hmm. Once we get these things properly defined, then we go about the business of constructing a portfolio and instituting the investments in that portfolio. Mm-hmm. After we do that, we, of course, monitor not only the investments inside the portfolio to make sure that they are continuing to do what they were originally intended to do, but we monitor the markets, the stock market, the economics. We monitor oil prices and interest rates, and of course that's a hot topic today.
Sure.
And we also monitor the investors themselves. Have there been any major changes in their lives that we need to address? So when we do all this monitoring, it's in an effort to, at some point, probably make some adjustments to their investments as time goes on.
So let's shift gears here a little bit. Let's talk about a little bit of real estate. So what is a REIT, R-E-I-T?
A REIT, R-E-I-T, it stands for Real Estate Investment Trust. And a real estate investment trust, you probably know about mutual funds, how
Right.
where people group their money together, thousands of folks put their money together, and they go out and they buy investments.
Right.
The same thing happens in a real estate investment trust. Thousands of people are pooling their monies together, and the real estate investment trust sponsor goes out and buys properties, commercial properties. It's either going to be office buildings, it could be apartment complexes, it could be medical facilities, it could be many storage facilities all across the country.
Sure.
Typically, these companies will raise, if we're talking about a non-traded type REIT, they'll raise anywhere from $1 billion to $2 billion.
Wow.
Go out and purchase this real estate, manage the real estate, returning about 90% of all of the revenue from the properties back to the investors while they're holding it. And then they'll have a liquidation event at some point in 3, 4, 5 years down the road where they sell off the portfolio either to maybe an endowment or another company, and returning the principal back to the investors, and hopefully with a profit on that.
That's awesome. And so real quick takeaway, what's the difference between a traded and non-traded REIT?
Yeah, a traded REIT really can move in sympathy with the stock market because it is traded on the exchanges just like any other stock. So an issue that I have with a traded REIT is that if the stock market were to collapse like it did back in 2008 and 2001 and so forth, many of these REIT stocks will trade in sympathy with the market in general.
Right.
When you have a non-traded REIT, of course the benefit to a traded REIT is you can call me up and sell out that day and get your money, okay? So it's a traded REIT. A non-traded REIT is you put your money in.
And you can just swing with the fences. You can just hold.
Well, you have to hold.
Right.
You can't call me up and say, hey, Greg, I need to get out of this. No. When you come into a non-traded REIT, you're in for the length of the term, which, as I said, might be 4, 5, 6 years.
Whenever it balloons or whatever.
Well, whenever they have a liquidation event or an
Sure.
exit strategy.
So for more information about any of these topics, you can get a hold of Greg Drew at 210-789-5364. Again, that's 789-5364. Or email him at gdrew@satx.rr.com.